What's up, guys? Today we're doing video number 2 of my easy day trading series where I show you how to find simple setups to make big profits day trading the stock market. In this video, we're basically going over the opposite version of the setup that I laid out to you in part 1. I know many experienced traders are going to look at this and say it's just a descending triangle, but I do not believe anyone should simply trade patterns. You have to respect price action, and there are several factors that are going to validate if a pattern is likely to play out in a particular way. So let's dig into it with a nice trade we got on Tesla in early February. Much like in video 1, we need a couple things to even consider playing a stock with this setup. Beginning with A, you have to have volume. Without volume, there's no one taking the opposite side of your trade. You're going to get huge slippage, there's going to be bad fills, and quite frankly, if there's not volume on the stock, that means that everyone else is looking at another ticker, which means you're missing out on the opportunity to play the stock that has, good odds. So why do it? Don't play a stock without huge volume. Second, volatility. If there's no range, then there's no play. And so how do we go about determining if there's enough range for us to play on an entry? Well, the easiest thing to do is to just basically look at the pre-market situation, see if there's any kind of big movements, and look at the previous few days to see if there's some serious range. And if we take a look at Tesla, every time this thing breaks a level, we're getting 10, 20, 30, $40 moves. So, with this stock in particular, we knew that there was going to be enough volatility for us to make a profit. So the next thing to consider anytime you're about to take an entry on one of these setups is you absolutely have to identify the trend. And how do we do that? Well, on this stock in particular, the price action opened up, we got a dip, pushed, rejected hard up here, and then it made lower highs all the way down. So what is a lower high? A lower high is basically after you have a dump and the price action pushes up to a new spot, that the peak of that pushback up is lower than the previous high price on the last move up. So this would be a lower high of this price. This is a lower high of that price. This is still a lower high in the trend of either one of these prices. And this is a lower high. So what happens is we end up having 3 lower highs in a row that if we draw a line down connecting them, we have identified that this is a downtrend, because every time the price action moves up after a move down, it's lower than the last one. So the price is moving down over time. This is an incredibly crucial step and a very basic skill in trading. If you cannot learn to do this, you're going to have a hard time being successful. So most of your time needs to be spent identifying patterns and identifying the trends. It's incredibly important to know where your trend is at, because let's check it out. If you know that you have a downtrend, well, basically, any time that you go short inside of the downtrend, you're going to make money at some point. Now, part D. What you need to consider next is, what is the price action going to look like at the key levels? If we get down here to the 750 level and it breaks this big support zone, is it likely to just kind of flounder around and chop around 750 a few dollars, or is it going to snap? How do we know? Well, we have to go back and look at previous price levels and see if there were big reactions to them. So let's scoot back. Up here it looks like we formed a bit of a support at 790. Out the gate it popped off of it. We came down again, wicked through, bounced up a little bit, and then consolidated right here at 790 again. And when it finally broke, it snapped down. So we're going to put that in the column of it's likely to break pretty hard if it's a strong level. So if we move back a day or two and take a look at some of the other levels that we can identify and see what happened when those levels broke. All right. It looks like at some point this 900 area was fairly strong level. You know, we got up here above the open price, we pushed up pretty hard, consolidated. When it finally gave in, it snapped, built back up to it, got a big consolidation, and then once it broke through, it popped up and more or less grinded the rest of the day. So it's more support that we should get a fairly decent move off of that level. Let's scoot back one more day and see if we can identify any levels that seem to have mattered. Looks like early on we had this big consolidation around 700. Once it broke through, we pumped. More or less, it seems like there's a lot of range after we have significant price action at the key levels. Then we have the last step, part E. Is there consolidation for this setup? Well, let's take a look. On this one, again, we identified our trend. We knew there was volume, there's volatility, and we had this really nice psychological level of 750. And if we scroll back, the $750 level was important previously, and we kind of decided that this was a spot. Also, came down here, we bounced off of it 1, 2, 3 times, and we kept inside of this downtrend. So what I would consider all of this price action in this area is consolidation. The longer that it stays in this area and is building in, not breaking the downtrend and sitting on top of this price level, the more likely that it is to have a strong reaction when the trend or the price level gives way. And we see that very quickly on this one, where as soon as it dropped through, it just snapped $10 and we were off to the races with our shorts. So after we identified everything, we're watching this like a hawk. We know that this is our spot, and as soon as it dropped through just even a little bit, we hopped in short and rode it all the way down. So all of that was how to identify the trade. Now how you actually play it, you can do it a couple different ways. You can, after you've identified the trend, you can wait until it goes up to test the trend and hop in short and put a stop loss slightly above where you would expect the trend to be broken. You could take a starter there and sell into the push down, or you can wait until we have confirmation that the level or this support here that we were waiting on breaks, and then hop in short there and put your stop loss either somewhere relatively above the original level so that you're giving it a little bit of room to breathe, or you can put it over the last lower high that happened before the trade triggered. The keynote with using this strategy is that if you're going to hop in short, wherever you're at, you need to make sure that the risk, wherever you plan to put your stop, and the amount that you can potentially profit are some sort of multiple of each other. I usually for scalps do a minimum of 1-to-1, and for longer trend trade setups like this, I would try to get 2-to-1 on my whole position. So what that means is if I hop in right here on the break and I want to see a $5 to $10 drop average profit on my short, that at most I want to risk between $2.50 and $5 on a loss. So I would put my stop, let's say it's, I hop in right at 749.50 or whatever, and I'm expecting $10. Well, if I want a 2-to-1 trade, that means I can risk $5 in order to make $10. So if it goes against me, I'll lose $5, and if I profit, I make $10 on each share. So identify that spot, put your stop over here, and take your profits down here. It's real simple. The reason why this works, even though you say, well, if I lose $5, and that happens a lot, then I'm losing money. But it makes sense when you're going through all the effort to identify these trends and you have figured out through testing and practice that this setup is going to have a 55, 60, 65, 70, 75% win rate. Well, then you know if you're making 1-to-1 that you're still making profit with the 75 for any kind of win rate over 50%. If you're doing a 2-to-1, you're making any kind of profit over any kind of win rate of, I think it's 30% or something. Yeah, 35%. So know your risk to reward, do the math, and make sure that you're putting yourself in a good position to profit every time you enter. Wrapping up, there you have it, the easiest day trading setup. Part 2, instead of going long on the ascending triangle, we're going short on a descending triangle. It's very easy to identify. It comes up all the time in the marketplace, and I hope that the next time you see it, you'll know how to play it and make a profit. Thanks for watching. If you have any questions, feel free to send me a DM on Twitter. It's @Confused, and if you like what you see here, just know we're doing this every day at the Ramp Up Trading Room. You can find that at rampuptrading.com.